What's up, everyone? We got a really good one today, and so strap in, and of course, all the OG house cats drop a meow in that chat. You're watching More Money? Let's get it.
What is up, everyone? It's been a long time, I guess over a month now since my last video, and I apologize for the delay. I've just gotten a new job and then I moved to a different state, so it's just been really busy for me. But I really wanted to cover the Alibaba fiscal year-end results, specifically the March quarter that they just released. And so you can see right off the bat that they're calling out that their China and international commerce business realized double-digit year-over-year GMV growth. But pay attention that they're calling out GMV growth and not revenue growth here. So, I mean, specifically, we'll dive into the details, but notice that overall, the company delivered a strong quarter of revenue growth of 7% year over year, and overall, like, the year was good too, and I'll compare that to what my expectation was. But of course, during the year, they increased their repurchase rate to 12.5 billion shares, and they approved a $4 billion dividend. Part of that dividend is actually a special dividend, which I'm going to dive into in a second. And you can see that the market right now ran up yesterday around 5%, or actually closer to 7%, up to $85 per share, approximately $85 per share. But you can see that in pre-market trading, the company shares are trading down. I'm not really sure what prompted the run-up. The shares ran up a lot over the last couple of weeks, and so I guess now they're just starting to come back down. This is typical Alibaba quarterly behavior, at least what we've seen over the last couple of quarters. And just to level set, the model that I had on Alibaba, I was expecting revenue growth for the year of around 3.7%. So the fact that they're higher, saying that revenue's growing around 7% for the year, that's definitely double what I was expecting. I think they said it was 7% for the quarter, but I'll show you what it was for the year. So yeah, you can see it was 7% for the quarter, but it was actually 8% for the year. So, they grew more than double what I was expecting on consolidated revenue. So that's not a bad thing. 8% was kind of where I was before. It was kind of bang on. I was forecasting around 7.5%, but then I got mad with one of the quarters and I brought it down, and they definitely outperformed. I think as I reforecast this thing out, I'll probably land somewhere around the 5 to 7%, maybe give them 6% revenue growth until they can give us more guidance on what's happening with China commerce, or I get more confidence that China commerce will grow. You can see I've highlighted in blue that China commerce still remains the challenge, right? It's only up 5% year over year, and the direction that China commerce goes is the direction that the company goes, because you can see how much of the overall revenue China commerce is. And then of course you can see that their diluted earnings per ADS is actually up 14% year over year, so not a bad year overall. Now the first thing I wanted to point out is that they've increased the rate at which they are buying back shares, so that's fantastic. The number of shares were reduced by 5% in 2024. If they continue to grow revenue and earnings at around if they just continue to increase earnings per share at 15%, 10% even, and they're buying back 5% of the shares every year, I'm okay with that. But take a look at this. So they've announced their annual dividend. But in addition to that, look at this. They announced a massive extraordinary cash dividend in the amount of 66 cents. So typically you get $1, but this time you're getting $1.66. And so that's fantastic. I mean, overall, it's still a small portion of probably what you've invested in the company, but it's nice to see that they're returning cash to the shareholders, both through higher repurchases and through special dividends. So I want to see more of this. This is fantastic. And you can see for the year that they've earned $22 billion of free cash flow. They repurchased, they used 12.2 of it to repurchase securities. So their cash balance actually went up. And the current cash balance of $62 billion reflects around 30% of the current $200 billion market cap. And of course, if the shares decline today, that cash balance reflects a higher amount of that market cap. Now, also keep in mind that 5% reduction in share count is a net reduction, net of equity granted to the employees. So just keep that in mind. That's something that we actually do forecast in the model. And so my free cash flow that I forecast for Alibaba is a free cash flow per share net of equity awards. And so overall, I think you should be expecting more dividends or increased share, like more special dividends or increased share repurchases as time goes on. Company has a lot of cash still. And just quickly on the first look, I just wanted to look at a couple of the segments. So the first segment was the Taobao and Tmall group. This is by far the most important segment for the company. And you can see that price competitiveness is still occurring in this segment. They're saying that it's yielding strong results, but really overall revenue growth is, it's not bad. It's what we expected, but it's far from the double-digit historical revenue growth that this segment used to achieve. And, I don't know if those days are going to come back. I definitely wouldn't forecast using double-digit revenue growth for this segment. And you can see that part of the reason why revenue growth is still in the low to mid-single digits is they're using new models that have lower take rates, and so lower monetization rates for the business as a whole. And I think they could potentially be hiding the fact that it's just more competitive now in the online China commerce market. And so, it's something you have to contend with and you have to build into your model. And it explains a big reason why Alibaba's shares have declined so much. And then the other segment that I wanted to cover quickly on the first look is the international segment. So this one has sort of been bailing out the China commerce segment. If international was not doing as well as they are doing, like look, the revenue's up 46%. If international was not doing as well as they are doing, Alibaba's results would be much worse. I think they wouldn't be able to hide the fact that China commerce is as slow as it is. And so a lot of credit to the international business. And so you can see that AliExpress's choice product is continuing to grow quickly. This is the equivalent of Amazon Prime. And, they've mentioned, and I'll speak to this in a second, but they mentioned that synergies between AliExpress and the cross-border logistics operations of Cinyao have, and I'm sorry, I always pronounce that wrong, have further strengthened AliExpress's competitiveness with both the 5-day and 10-day delivery completion rates doubling year over year. And this is why I felt like this particular segment should not be sold off. It needs to stay with the company because it's so important, not just for China commerce, not just for the new businesses that they're using to compete with Pinduoduo or Pinduoduo, I think that's how you pronounce it. And of course, in international, it just made a lot of sense to not sell off any of Cinyao. And I'm glad that they reversed course on that. And then, of course, that obviously means that the success here causes success for revenue in the international business. And so that's really good. The only other area that I would want to pay attention to is how much money is Lazada losing. And so, Lazada continues to grow and their loss per order continues to narrow year over year, which is fantastic because, you're competing against Shopee. And Shopee definitely takes large losses per order. In fact, it's just a KPI that they report. So it's really tough to compete against Shopee. So it's interesting to see, and it's good to see that Lazada is able to continue to compete with them in the Southeast Asia market. And so just quickly looking at the valuation, this valuation is not up to date right now. I have to update for their fiscal or the 2024 results that they just released. So this will change. But, some of you guys might be asking, why has the valuation come down so much over the years? And really, it's just the weakness in China commerce. And so if China commerce continues to be weak, this will just continue to come down. And so, we'll see how I forecast these segments out and where this lands. I do it at such a granular level that I don't really know what the valuation is going to be until I run everything through. And so this is where it's sitting at right now. I still am a Alibaba shareholder. we'll see what the current share price reflects based on the new forecast. This is old, but it's saying that it's reflecting 13.8 times earnings. Probably will be lower than that. I presume it'll probably go down to the 12 times. Now, if you want access to the model, it will be updated shortly. You can get access to the model and all of my other research. I just updated my 10-cent model, Starbucks. There's a bunch of names that I just updated. There's a lot of names that I don't talk about on my videos that that I find interesting opportunities that are on the tracker. You can get access to all of that at that lower tier. And if you want to join us on an Epic Live presentation, I think this is the best value, best bang for your buck. And the stickiness of this is incredible. We've had people on these calls for years now, and I'm talking more than around 3 or 4 years, like as long as I've been on YouTube. The stickiness of this tier is fantastic, and I think what it speaks to is all of the work that goes into each one of the calls. I spend around 8 to 10 hours preparing for each call, and so I think it really resonates. There's over 200 Patreons that are a part of the tiers, and I'd love for you to try it out. And what I always say is, if you try it out and you don't like it within the first month, just let me know and I'll completely refund your first month subscription. I don't want to take money from anybody who doesn't get any value out of the call. And so I'll leave it there for you guys. You guys let me know what you thought about the quarter, and we'll go from there. Okay, see you guys.